Welcome to this video, and in this video we are going to discuss about capital rationing. So we are going to look at how to make investment decision under capital rationing. And when we talk of capital rationing, we mean making an investment decision when you are affected or when you are limited with sufficient cash. Theoretically, in the net present value, if a project has got a positive net present value, you are supposed to accept that project. But in reality, the investment is affected by the amount of budget that is available. So you may have projects with the net present value that is positive, but you don't have enough cash or enough budget to support that investment. So in this video, we are going to look at if you are facing a budget constraint, how do you make an investment decision? And when it comes to capital budgeting, when it comes to capital rationing, we are going to look at the two types of capital rationing. That is the soft capital rationing and the hard capital rationing. Then we are going to look at how do you make an investment decision if we are constrained with a budget. So as said earlier, capital rationing means that the company has insufficient cash to invest in all projects that have a positive NPV. So you have an investment that has got a positive NPV, but you don't have enough money to invest in that project. Then in that case, we say you are having a budget constraint, or you have what we call a capital rationing. And as I said, when it comes to capital rationing, we classify it into two. We have a soft capital rationing and a hard capital rationing. So when it comes to a soft capital rationing, there are constraints or budget constraints that are mainly caused by internal factors and restrictions. So you have a budget constraint, and those budget constraints have been caused by internal factors. For example, you may find that the management did not budget for capital investment, or the budget that was provided by the management is not sufficient for the capital investment, or you cannot be able to raise money outside, or there are restrictions on raising the money outside. So those are internal factors that cause a budget constraints on investment. Then when it comes to hard capital rationing, there are budget constraints that are mainly caused by external factors. You cannot be able to raise money because of the external factors. For example, you may find that the company shares outside are very low. The price is very low, and you cannot be able to sell shares in the market. So those one we call them external factors, or they are constraints on the budget, but these constraints on the budget have been caused by external factors. So let's look at what are the causes of soft capital rationing. So one of the causes of soft capital rationing is that fear that additional debt may lead to outsiders gaining control over the business. So the shareholders may fear that if they raise money by issuing a debt, then the debt holders are going to gain control over their business. So because of those fear, then they are going to be reluctant to raise money by issuing a debt. So another factor that we can talk about under soft capital rationing is that additional share capital may lead to dilution of earnings per share. So the shareholders may fear that if they raise capital, or if they raise money by issuing shares, then it's going to affect, or it's going to dilute their earnings per share. So because of that fear, then the shareholders or the owners are going to be reluctant to raise money by issuing shares, which is going to affect our budget to invest. Another factor that we can talk about is the additional debt. Capital commits the company to a large fixed interest payment. We know that when you are financing using a debt, you are supposed to pay a fixed interest on your debt. So the owners or the managers may fear that if they raise money by issuing a debt, then it's going to commit them to pay a fixed interest on that debt, and they are not willing to be able to to make that commitment of paying a fixed interest, because maybe they are forecasting their cash flow forecasted may not be able to make them to pay that debt. So in that case, the managers or the owners may be reluctant to issue debt to finance the company's activities. Another factor that we can talk about is the management may wish to limit investment to a level that can be financed solely from retained earnings. So managers may not want to raise money by going external or through issue of shares or through of issue debt, and they want all their investment to be financed internally. So if you are going to use internal finance, and one of the main sources of internal finance is the retained earning. So you want to finance a business but using retained earning. So meaning that the project that you are going to finance or the project that you are going to invest in must be in relation to the amount of retained earnings that you have generated. So because you cannot go outside to raise money outside. So you can only going to use the retained earnings. So your investment is going to be constrained by the amount of retained earning that you have generated. Another factor we can talk about, and this is our last point that we can talk about in soft capital rationing, divisions are controlled by strict cash allocation. You find that you have a head office. The head office puts a lot of restrictions on the amount to be invested by the divisions or by the branch. So such that the head office or the branch cannot exceed the amount allocated to them to invest. So in that case, you are also going to have a constraint on your budget, and that constraint is caused by restriction by the head office to the amount supposed to be invested by the divisions or by the branch. So let's look at what causes the hard capital rationing. One of the factors that causes the hard capital rationing is that the share price are depressed. We have talked about this point that if the share price of the company is very low in the market, so it means the management may not be able to raise the capital by selling shares, because the shares in the market are selling at a very low price. So in that case, it's going to create a constraint on the budget of the company, because they are unable to raise money by selling shares, which has been caused by the low share price in the market. Another point we can talk about here is the restrictions on bank lending due to government control or debt covenant. You may find that the government puts a restriction on the amount that the bank are supposed to lend to companies. Maybe if it's manufacturing, you say you cannot exceed this amount. If it's a smaller company, you shouldn't exceed this amount. So those restrictions are going to limit the company to be able to raise money by borrowing, because the government has put a limit on how much you should borrow. So you cannot exceed the limit that has been put. So still on that same point is that a company may have other debts, and those debts have created certain covenants or agreements that a company must abide with. So, and you cannot, for example, the debt holders may put a restriction of getting another debt before completing the payment of their debt. So that is one of the covenants that can be put. So because of those covenants or those agreements, you may find that it limits the company to borrow money to be able to finance its activities, which is going to create a constraint on their budget to invest. Another one we can talk about under hard capital rationing is that institution may consider the organization to be too risky to invest in. You find that you have a business, but investors are looking at your business as a risky business, and no one is willing to invest in your business because they are considering it as risky. So because investors are looking at it as a risky business, then it's going to be very hard to be able to raise money outside. So in that case, the only way that you are going to be able to finance your activity is internal finance, and that means your budget or your investment, capital investment is going to depend on the amount that you have raised internally. Another issue we can talk about here is the skepticism about investment plans. You may find that people are not sure of or investors are not sure of your investment plan. They don't look at it as in a real plan. They are very suspicious about the investment plan that you have. So because they are suspicious, they are reluctant to give money or to raise money to finance those investments. Another factor we can talk about is that the investors have recently provided the capital. You may find that the investors have already given you money to invest, and at the same time you are asking another money to invest. So in that case, it's going to be very, very hard for the investors to give you another money when they have just given you money, unless you provide a good justification about the money that they have given you to invest before. So these are the factors that leads to a constraint in your budget or capital budget investments that is caused by what we call the hard capital rationing. So how do we overcome challenges of hard capital rationing? So some of the factors that you are going to look at when you want to overcome the challenges of hard capital rationing. One is to seek joint venture from partners. You can look at how you can partner with other companies, and then you do a joint venture in order to be able to raise money. Another one is you can have a licensing or you can franchise agreement with another firm. You can work with another company through licensing and franchising, and then you produce your product or you implement your project with other companies. Another one we can talk about is the contract output parts of a project. So instead of looking at the initial investment at once, then you can divide that initial investment into phases. And maybe say phase 1 we can invest in this, phase 2 can invest in this, phase 3 can invest in this, such that you split your investment into phases, which can become a bit simple for investors to accept. So another one, you can seek other sources of capital. You can go to different sources of capital. You can go for venture capital, you can go for debt financing, and other sources of finance, as we will look at them in our next videos. Now, when you are making a decision to invest and you are having a budget constraint, which has been either caused by soft capital rationing or has been caused by hard capital rationing, so your decision or your computation will be based on two things. First, you need to know whether the project you want to invest in are divisible projects, or the project you want to invest in are not divisible. So when we say that the projects are divisible, it means those projects can be implemented in phases or can be implemented in stages, and each stages may be independent from another. So in that case, you have a divisible project. So if the projects are divisible, then for you to be able to evaluate your investment decision, you are going to use what we call a profitability index. So if you have 5 projects, you are going to rank those projects using a profitability index. So you give resources based on the profitability index. So that is what we mean by divisible project. Divisible project, we said the projects can be implemented in phases and each phase is independent. So if you have those projects, then you are going to use profitability index. Please, if it is an examination question, you need to look at that. You need to look at whether the projects are divisible or the projects are not divisible. If the projects are divisible, then you rank the project using profitability index. So let's look at the profitability index. How do we compute profitability index? So the profitability index, we have got two formulas to compute the profitability index. You can get the present value of your future inflows divided by the initial investment, or the common one, which is the net present value of the project divided by the initial investment. So if we use the first one, the answer you get, you less 1. So this is the computation of the net present value. I think you remember this in our previous video. To compute the net present value, you get the present value of the inflow minus initial investment. Then you divide by the initial investment to get the profitability index. Or you can get the present value of future inflow divided by the initial investment, then minus 1. And then you can be able to get your profitability index. So I want us to look at this example. We have got 3 projects: Project A, Project B, Project C. Project A requires 100 million, Project B requires 200 million, and Project C requires 300 million. And these are the net present value of each project. Project A, the NPV is 225, the Project B is 520, and the Project C is 540. Now they say the projects are divisible. This is the most important part in answering this question. The projects are divisible. The moment you see that the projects are divisible, then in that case, you are going to rank your project using profitability index. And we have got a constraint of 500,000. Remember here, all the 3 projects to be implemented, you will need 600,000. But our constraint is 500. We cannot exceed this budget, meaning automatically you are in capital rationing. Because if you look at the amount that is the amount you want and the amount is available, the amount you want is more than the amount you have, the amount that is available. So in that case, you have a capital rationing constraint. So when we are dealing with this, the first step is to rank the project. And how are you going to rank the project? You are going to calculate the profitability index of that project. So remember what we said. To calculate the profitability index, we have looked at the 2 formulas. The first formula, you can get the net present value of this project divided by the initial investment. You get to 2.25. The second, net present value, you get this, you get this. The third, you get this, you get 1.8. So if you look at this profitability index, it is project B with the highest profitability index. So in this case, project B is going to be ranked 1. Then when you go to another project, it is project A, will be ranked number 2. Then project C will be ranked the number 3. So it means this project B, you are going to use all the you will invest all the available fund in this project, the 200. Remember our constraint is 500,000. So project B, you can use the whole 200 on it. Even project A, you can use the whole 100,000 on it. So if you look at the 2 projects, these 2 projects, we have already used 300,000 on the 2 projects. And this project C requires 300, meaning the available fund cannot be sufficient for project C. So the available fund remaining is 200. So it means we shall only invest 200 over 300 of this project. We cannot exceed that. Project A, you are going to give all the whole amount, and the NP is 520. Project 2 or Project B, we are basing on our ranking. We give the whole resources of 100%. It becomes the NPV is 2.225. Project C, you are only going to invest the remaining balance, which will be 2/3. So the NPV will be 2/3 of the 540. So meaning project B, you can only invest 200,000, which is going to be 75%. 75 or 60 something. it will be 66%. That will be 66% here, and the NPV will be 2/3 of the original NPV of this project, and then you compute your investment plan. So what are the challenges with the profitability index? So one of the challenge of profitability index is that it can only be used if the projects are divisible. If the projects are not divisible, you cannot use profitability index. Please mark that. The profitability index is only used if you have divisible project. So that is a limitation to the profitability index. Another limitation is no account is taken of the strategic value of the individual investment to the organization. So let's look at non-divisible projects. So non-divisible project, it means you cannot implement the project. You either implement it or you don't. You cannot say that I implement this part, then after another year I implement this part, and then this, and no. The project must be implemented once. If you start, you have started it. Then in that case, that project is not divisible. And if the projects are not divisible, and you are facing a budget constraint, then you use net present value. You are going to look at a combination of the project that gives a highest net present value. That is the project that you are going to take. You may find that the combination does not exhaust all the resources, but you will look at the first criteria that you are going to look at is a combination that gives the highest present value, net present value. But you may find that you have two projects, you have two combinations, they have the same net present value, then you are going to look at the combination that try to exhaust as much resources as possible. Then it's going to be the one to consider. But please, if the projects are not divisible, you are going to look at a combination of projects that provides the highest net present value. That is going to be your investment plan. So we have got this example on this part of project A, project B, project C, and these are the amount required for this project, and these are the net present value. So the projects are not divisible. That's the most important part. As I said, when you are answering this question on capital rationing, you need to look at whether the projects are divisible or the projects are not divisible. So in this case, they are telling us that the projects are not divisible. So if the projects are not divisible, then automatically we are looking at the combination which gives us a highest net present value. So if you look at this project, of course, we cannot take all these three projects because the amount for these three projects is 600. You get 100 plus 200 plus 300, you get 600. And the available fund is only 500. So meaning you cannot be able to take all the three projects. Now what we do, we are going to look at a combination which is going to give us the highest net present value. I think you still remember these permutations, combination and permutation in quantitative techniques. So the first combination we can have is project A and project B. So if you combine these two projects, project A require 100, project B require 200. So the total investment will be 300,000. And what's their NPV? The NPV will be the NPV of A plus NPV of B, you get 745. Then another combination comes from project A and project C. So if you combine their investment, it's going to require 400,000. And their NPV total is 765. If you combine project B and project C, it's going to exhaust our funds. It is 500, and its NPV is 1060. So if you look at this, it is project B and project C that gives us the highest NPV. So if you are to select, you are going to select a combination of two projects, that is project B and project C. So thank you very much for watching my video on capital rationing. My next video, we are going to look at adjusted present value. But before we look at the next video, I want to sum up what we have discussed in this video. So we have looked at capital rationing, and I said capital rationing, you are facing a constraint of the budget. You don't have enough cash to invest in all projects that you have identified. And the capital rationing, I said, it is caused by either a soft capital rationing or a hard capital rationing. Soft capital rationing, we said those are internal factors. And hard capital rationing, we said those are external factors. Another important thing we have looked at is divisible and not divisible. Because we said when you want to make a decision, you need to look at whether the projects are divisible or the projects are not divisible. If the projects are divisible, then you rank the project using profitability index. But if the projects are not divisible, you are going to look at a combination of projects that gives you the highest net present value. So that is what we have discussed in this video. Don't forget to subscribe to my channel to be able to get access to my videos as I thank you.